The housing industry has spent the winter waiting for a savior. Today, the financial establishment thinks it found one in Switzerland. Following a diplomatic pivot at the World Economic Forum in Davos, the 10-year Treasury yield plummeted to 4.251%, snapping a streak of rising yields and offering a much-needed cooling effect on the cost of capital. The market is celebrating this relief rally, hoping 30-year fixed rates will make a run for sub-6% territory. But relying on geopolitical headlines to save domestic housing margins is a fool's errand. The builder's dilemma. While bond markets rallied yesterday, the home building sector remains anchored to reality. The January NAHB Housing Market Index confirms builder confidence remains stuck at 37.0. More critically, 65% of builders are now actively using heavy sales incentives to move standing inventory, with the average price reduction hitting 6%. Builders are in a defensive crouch, forced to bleed massive margin on upgrades and closing cost credits just to meet Q1 sales quotas. A temporary dip in the 10-year Treasury does not fix this structural bleed. The Wall Street landlord distraction. Meanwhile, Washington has decided to attack the only players actually bringing liquidity to the market. Discussions are intensifying regarding a federal ban on large institutional investors purchasing single-family homes. While institutional investors own only 2% to 3% of rental housing stock nationally, they are a primary political target. Threatening to sideline institutional funds does not build more houses. It simply removes vital, all-cash, no contingency capital from a market starving for transaction velocity. The PropTech AI reality check. As operators bleed margin, the PropTech establishment is facing a severe ROI reckoning. Recent studies show the actual ROI on AI implementation in property management and legacy portals has been only 10% to 15%, far below the silver bullet expectations of the last 2 years. The industry is wasting capital trying to build automated AI agents for legacy workflows instead of engineering structural solutions to the transaction itself. You cannot automate a broken process, and you cannot rely on Davos to fix your margins.